Hello and welcome back to Game of Trades, your number one channel for videos on the stock market and cryptocurrencies. Consumer sentiment reached historically depressed levels in 2022. We've now seen consumer sentiment somewhat begin a recovery. Of course, as inflation comes down, gasoline prices stop rising, food prices stop rising, rents stop rising, well, you can see the consumers start to get more optimistic again. And what has that historically meant for stocks? Well, big bottoms in consumer sentiment have coincided with the largest market bottoms throughout history, right? That includes 1980 here, 1974 right here, and has systematically triggered massive upside for stocks. Now, of course, that's being met with a lot of skepticism from investors with the AAII bull ratio, the percentage of people who are bullish on the market versus the number of people that are bearish on the market. If you smoothen this indicator out, you put a 50-period moving average on this indicator, well, we are officially in the most bearish period of the stock market history. Of course, you know what they say, buy when others are fearful. And that has certainly been our opinion. But now with the market up 16% off its low right here, just a massive run up, a lower than inflation print, triggering a massive move up here. The market's still clearly in a solid downtrend. If you look at the key daily moving averages, the 100, 150, 200-day moving averages all pointing down just like they were pointing up throughout COVID. Are we about to see this rally reverse? We also have a very important trend line here that captures the most important highs of 2022. I think there's going to be a lot of pain in this area for a lot of people, and I'm going to show you why in this video. By the way, if you are new here, don't forget to smash that subscribe button because we make these videos multiple times a week. And also don't forget to click on that like button if you enjoyed this video. Now, without further ado, let's get right into it. Now, if we go to one of the key strategic articles that we posted over the past few months, I want to quickly show you this chart here, and that is good spending is normalizing right here. This is the year-on-year change in real good spending. So good spending adjusted for inflation. And to me, this is really what drives recessions. It's what drives economic booms. When people go out and spend, the economy grows, it's strong, and unemployment doesn't go up. When good spending collapses, well, that's typically accompanied with poor economic conditions. If we scroll up here, you can see very clearly all these periods where consumer spending goes down, well, the unemployment rate goes up. Consumer spending goes down, unemployment rate goes up. Again and again throughout history, again here in the 90s, consumer spending goes down, unemployment rate goes up. Now, what's very interesting and what triggered a lot of recession talk throughout 2022 is that we saw good spending collapse here. You can see this black line collapsing, and yet the unemployment rate stayed low. It's staying low, and now we're even seeing good spending normalize. So this is really the first time in history where we've seen such a dynamic. I think a big part of it is because of COVID, that you had such a disequilibrium in the spending patterns of people, and also the central banks came in and just shoved a huge amount of money in people's face. So that disturbed the entire dynamic that you've seen throughout the past 60 years here. But this, to me, this chart of good spending normalizing and coming back into the positive range is telling me we're not in a recession, not yet at least, and that the consumer is resilient. It's been resilient to the inflation shock. It's been resilient to the interest rate shock so far. Now, down the road, are we going to see a recession? Yes. Recession always comes. Are we in a recession now? That's another question. If you look at the stock market ever since World War II, right, so that's almost 100 years of stock market history. We're excluding the Great Depression, but you can see we can count the number of times we've had 2 consecutive down years on the stock market. One in 1945, one in 1974, one in 2001. Throughout the dot-com bear market. Those are the only 3 periods where we have 2 or more consecutive red candles. Ever since 1944, we've seen all red years be followed by a green year. So this is really just to put some perspective around what's going on today and the odds of this getting a lot worse from here. Of course, things could get worse, but things can also get better. By the way, don't forget to smash that like button if you're so far enjoying this episode. It really is appreciated and it helps push our videos out to more people. So thank you for taking those couple of seconds to go ahead and do that, because we really are trying to push our research, our work, our way of understanding the market to show as many people as possible our website that really helps individuals of all skill levels through this complex market. The aim is to guide you through all the noise, through all the emotion, the swings up and down in the market, and give you a clear strategic view on the market. If you are interested in this kind of service, make sure to go and grab yourself a free trial. It is completely free for 7 days, so you can check out the website, see if you like this type of service, and whether or not you want to join our community of thousands of investors. Now let's take a look at the technical structure on the S&P 500. Now tomorrow on gameoftrades.net, we will be posting a piece of work covering the sustainability of this run. There's quite a lot of signals that we're seeing underneath the surface that are giving us some hints regarding the next move on the market. What I wanted to talk about in this video with you guys is this area right here. Now, this is massive resistance. This is actually our second target that we have on gameoftrades.net. We hit the first one right here at 3,900 points. We cleared it. Now, second big target stands at around 4,150 points. And this is a level right here that everybody is looking at. Everybody knows that this is a significant line of resistance and that we need to pay attention to it very carefully. I think there's a lot of shorts. Remember this chart, the AAII bull ratio, the amount of short interest that we have in the market right now. Huge number of bearish investors in the market today. So I don't like to try and predict short-term price action, but I can tell you right here that there are a lot of stop losses around this area right there. So if you start to see the market move higher right there and break through this trend line, it could very well potentially trigger a short squeeze, right? And see 4,400 points in very short order. Now, of course, we'd need to see good news for that. For example, the Fed really starting to show signs of pivoting, right? More recently, we had the 10-year minus 3-month yield curve go inverted, right, for the first time since 2019, where the Fed pivoted. Before that, it was 2006 where the Fed pivoted. To July 2000, the Fed pivoted. 1998, the Fed pivoted. So it seems like we're at that point where we could get that type of rally if you start to get the Fed changing their tone a little bit and the market reacting to that. Now, of course, I don't read the Fed's mind, and I don't pretend to. This is also a key resistance here. I don't think we're going to get a textbook reaction off of this level. I think if you're waiting for that type of thing, if you're short on the market, and this is something I was saying on a recent premium video on the website, if you're bearish on the market and you want to bet on more downside, don't wait for the market to get here, because by the time the market gets here, it's probably being short squeezed. We have a bullish structure right here. 3,900 points is very strong support. If that gets broken, you do start to see increased odds of seeing more downside in the near term, potentially retesting that 3,600 point support zone. Now, that's about all I wanted to cover in this episode. I hope you guys enjoyed. If you did, make sure to smash that like button and also click on that subscribe button if you haven't already. Now, in the meantime, I wish you good luck on your trading and see you next time.